In this video, we're going to look at Novartis. Novartis is one of the largest drug manufacturers in the world. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at their financial ratios and compare them with their competitors. I do this with you during the video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $198.8 billion. And they're trading at $86.50 per share. And next we got the free cash flows. And free cash flow is the cash flow from operations minus capital expenditures. And the way you value a company is you estimate the future free cash flows and then discount that number back to today's value. And that's exactly what I'm doing in this video. Now I'm pulling the net income, which is the profit and loss on the income statement. And then I'm going to pull the revenue, which is also on the income statement. That's the sales for the company. And the numbers look pretty steady. Not too much growth in revenue, at least. Free cash flow has been increasing though. So we should get a good value for the company. Let's look at the capital structure to figure out the discount rate we need to apply to the future cash flows. The interest they pay on their debt is $850 million. Let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. Current debt of $6.8 billion. Long-term debt of $20 billion. Debt payments are tax deductible, so let's get the effective tax rate. Go back to the income statement, get the income before tax, $8.9 billion. The income tax, $1.8 billion. So the effective tax rate is 20%, so the cost of debt is 2.5%. Next we need the cost of equity, and we need the beta to figure that out. The beta is how volatile the stock is relative to the market. And the beta is 0.45, so the stock moves roughly half what the market moves. The lower the beta, the lower the risk, and the lower the weighted average cost of capital. Let's go back to the balance sheet to get their current assets. And current assets are the funds you use to run your day-to-day business. It generally includes cash, accounts receivables, and inventory. And that's $29 billion. Let's get the current liabilities. These are debts and payables that are due within 1 year. That's $28 billion. We also need the equity, which is the value of the company according to the balance sheet. That's $55 billion. Equity is assets minus liabilities. We also need their EBIT, earnings before interest and taxes. On the income statement, that's called operating income, and that's $9 billion. Let's look at a capital structure. So they have 33% debt, and the cost of debt is 2.5%. They have 67% equity, and the cost of equity is 5.8%. And the weighted average cost of capital is 4.7%, which is a blend of the cost of debt and cost of equity. That's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using a weighted average cost of capital. And we get a value of the company of $334 billion. We divide that by 2.3 billion shares. And we get an intrinsic stock price of $145. It's trading at 86, so it's trading at a 40% discount. So it's a strong buy according to the model. Let's see what Simply Wall Street values the company at. They're even higher. They're at 170. So according to Simply Wall Street, this is their expected future free cash flow. $14 billion in 2021. Then it goes up to $19 billion. So their expected future cash flow is much higher than mine. It appears they just looked at other analysts' predictions of their future cash flows. So 7 analysts predicted on average $14 billion. 4 analysts predicted $16 billion. So every analyst has their own model, their own assumptions. My future expectations are generally based on prior financials. I try not to put too much emphasis on anything else because I think prior financials are the most indicative of the future. Let's look at the historical stock price to where it's been trading. It looks like it was trading close to $100, maybe in the mid to high 90s a few months ago. Then it dropped a lot in March, but it's come back up to around 86, so it seems to be a really good value at that price. Let's look at the financial ratios. PE of 16.9, which is decent. That's price to stock 86.50 over earnings per share. Earnings per share is net income over shares outstanding. I like to see below 15 for this ratio. They have a price to sales of 4.1. That seems a little high also. That's price to stock 86.50 over sales per share. Sales per share is revenue over shares outstanding. I like to see below 2.5. Price to book of 3.6. That's price to stock over book value per share, and book value per share is equity over shares outstanding. Their current ratio is 1.0. That's current assets over current liabilities, so they can just cover their current liabilities. ROE at 21%, that's pretty good. That's net income over equity. The interest coverage ratio is almost 11. That's EBIT, $9 billion over interest expense, $850 million. So they can easily cover their interest payments. And debt of 33%. The best way to look at ratios is to compare them to similar companies. I've done videos on AbbVie, AstraZeneca, Biogen, Johnson & Johnson, Eli Lilly, Merck, and Pfizer. And these companies are in the same industry as Novartis. And if Novartis' number is in green, that means they're better than the average. If they're in red, they're worse than the average. So they have a better than average PE, price to sales, and price to book. Their current ratio is below average, but it's still 1.0, so that's fine. Their ROE is below average. It seems like this industry has naturally high ROEs. The average is 48%. Their debt is lower than average, which is good. And their market cap is really high, but other companies are even higher, like Johnson & Johnson, Merck, and Pfizer. So it looks like a great stock. It is a great company. It's kind of one of those companies that you buy, you could hold forever because it's always going to be there. So let me know what you think of the video. Thanks for watching.